There was a lot of market movement last week, and the S&P 500 ended up virtually flat for the week. But sectors were going all over the place, up and down. And we're going to try and decipher what took place last week, what it means for the markets coming up, because there is a big event happening this week. We've got Nvidia coming out with earnings after the bell on Wednesday. We'll talk a little bit about that as well, because this week in the AI space was a little bit concerning for what was happening, but we'll get to that. So let's take a look and see what happened with the markets last week. So if we look here, we can see the S&P 500 was, up 0.1%. Healthcare up 3.9%. Now, healthcare can actually do well in the month of November, and we're seeing a lot of investors go into this sector and biotech as well. Consumer staples was positive last week. Here's a surprise here, energy again. We're going to talk about energy in just a second because energy has performed well over the last few weeks. If you look at consumer discretionary down, communication services down, technology. Now, this doesn't tell the story because there was a lot of movement down in the middle of the week with technology and then up on Friday. So, we'll take a look at that as well. If we take a look here, we can see the TSX was up 1.4%. Europe was up. China was up. Emerging markets were up. So we saw the rotation out of technology, and it went into other markets outside of North America. And as well, the TSX in Canada did well. If we take a look at some of the subsectors here, here's gold was positive for the week, 2%. Gold miners up 5.2%. That really was on Monday. We saw Bear come out with fantastic earnings and the market loved it. So we saw gold miners do well and gold do well in that news. But they got hit at the end of the week. And so we'll have to see what happens with gold. Silver as well, the same basic fate for the week. Uranium was down again. So this has been a risk-off move. A lot of margin call, hot money is taking place, and so uranium has been suffering here a little bit. If we take a look at metals and mining, was also down last week, and nat gas was up. So November tends to be a strong month for natural gas, and natural gas has been doing well recently. Here's a graph that came out last week, and maybe this is one of the reasons why we saw oil doing quite well. This is the IEA, which is well followed in the space, and they came out and they changed the prediction of peak oil. So here, this black line is where they were before, and they said the peak oil was 2025, and we're going to see a slow decline going down. Just for reference, they have marked off the net zero policy here for 2050, what it would look like here. But more realistic, this is what their projection was. They came out and said, well, we no longer see 2025 as peak oil. We see 2050. So 2050 peak oil. And so slow growth, but yes, they say the world still needs oil at this time. So, that might have been giving the energy sector a little bit of a boost last week. Okay, I want to do a little spotlight on the energy sector because this is really interesting. So we're using the ETF in the States here in this panel here. This is XLE. You can see here that it went up here a little bit in 2023, and really it's been flat. It's in 2024, 2025. And if we take a look, this is the energy sector relative to the S&P 500 underperforming. You can see here we have seen a little bit of outperformance here. This is not the time when, on a seasonal basis, that the energy sector does well, but we have seen this rising here. Okay, so then we got this panel down here, and this is Canadian energy. So we're using ETF XEG, and we're using versus the energy in the States, XLE. You can see here that Canadian energy has been outperforming U.S. energy. Really surprising with what's taking place there. And here you can see it on an absolute basis. Now, this is while the West Texas crude has been going down in price. So we're seeing Canadian energy going up while West Texas is going down here. It's been a little bit of a rally in energy stocks. Maybe there's some expectations as far as announcements with approved projects as far as that goes, but we have seen the Canadian energy sector outperforming. But we're not in the strong seasonal period for the energy sector, so I would not be surprised to see it actually pull back here a little bit. And you can see here with the U.S. energy sector XLE, here we are really close to resistance here, so we could actually see it turn down shortly. Okay, so last week we saw at the beginning of the week, this was positive for the market. The Senate announces that, the White House said, we finally reached an agreement. The government's going to open. It's still taking some time for the government to open. Not sure when we're going to start getting some of the economic reports, but it looks like we have a runway to actually have the government open up. Here's Barrick on Monday. They came out with their earnings and soars to near 52-week high. And you can see here that Barrick was up on the day huge, and gold miners in general were up as well. This is one of the factors for the volatility last week. So a couple weeks ago, the expectations for the Federal Reserve to cut its key interest rate on December the 10th were 70%. And what we've seen is that slowly drop as investors start to say, we're not so sure. And it's really become a coin toss. It's around 50-55% expectation that they'll cut in December. So that rattled the markets. It was definitely a factor. Okay, here's something interesting. So we saw First Brands go bankrupt, right? So we're looking at this subprime space here, really. First Brands, Tricolor, then we got Primalend. And then we've got BlackRock coming out and facing 100% loss on a private loan. And it was just a matter of a month ago or so. They were saying, no, this is all good. But this is interesting. So we're seeing a lot of stress in the credit side, some of the private equity side as well. Here's something interesting. We saw Barclays downgrade Oracle's debt. So they downgraded to sell. So we're seeing this in the AI space. We're seeing a little bit of a concern about the whole financing structure, about there's so much money going to CapEx, how it's going to impact the companies. Here's Oracle's long-term bond here. Back in September, it was trading at 100. And look at this. It's now trading at 92. That's quite a drop in such a short period of time. Here's an interesting graph. So there are different vertical axes here. You have to be a little bit careful for what they represent. So it's not proportional for the CDSs. So these are credit default swaps. And so this white line here with the blue shaded area, this is Oracle. So you can see their credit default swaps are rising. That only happens when investors start to be concerned about the underlying health of a company. Now, it's not just Oracle. It's CoreWeave here, SoftBank, Amazon, Microsoft, Google. Now, is Google going out of business? Microsoft going out of business? No, I don't think they're going out of business in the short term here. But we are starting to see, in this case, here's Google. We are starting to see their CDSs go up here. Like I said, you don't compare them on the vertical axis here. Just take a look at the overall trend. So we're seeing Google go higher, Microsoft, which is in yellow. This is interesting here because it just all of a sudden jumped up here. So investors are really quite worried about if all these companies are spending so much on CapEx, and is it a profitable solution in the private markets at this time? And so there's a little bit of concern given how much money is being spent. Last week we saw CoreWeave come out, and their shares got hit hard after they came out and gave a warning for their fourth quarter sales. Now, what they said was we're having to lower our guidance on that because the supply side constraints. In other words, yes, they have a forecast of what they'd like to do with spending, but they need the data centers there. And recently they've had some issues in getting the data centers up and running on time. So we're starting to see more of these issues. So not necessarily a problem with AI, but the space of the ancillary businesses around AI. Last week, Morgan Stanley came out and said, they see up to a 20% shortage of U.S. power for data centers through 2028. That's a huge amount. Once again, if you take a look, the power that's being consumed and how much they're anticipating to bring up AI, you just can't build a power system within a few months. That's just not the way the whole permitting process takes place, et cetera, et cetera. This is one of the reasons why natural gas has become a little bit in favor with natural gas companies, because The only way to do this in the short term is to actually use natural gas. So we're starting to see more and more of this. The one that people talk a lot about is Meta signing up the deal with Pembina, just outside of Edmonton. They would like to build a data center and really supply natural gas. That they can't build out other nuclear, for instance, in the short term. It's just not in the cards. I found this interesting. Data centers in Nvidia's hometown stand empty, awaiting power. So once again, there's issues in trying to get this total build out to all connect. And so we're starting to see some hiccups along the way here. I found this interesting. Last week, we saw ByteDance come out and unveil China's most affordable AI coding agent at just $1.30 a month. Okay, this is quite interesting. I don't know if they're just trolling the U.S. because the U.S. is just sucking up all this capital, and the Chinese are doing it a little bit differently. So the U.S. solution here is they're spending a lot of money here. With the hyperscalers. If you take a look, Chinese cloud firms spending a lot less. They're just trying to really maximize efficiency versus what's happening in the U.S. with just let's build brute force and let's run with that and try and get as much power as we can, etc. China's doing it a little bit differently here. This is the biggie this week. This is the earnings release from Nvidia Wednesday after the bell. It's always interesting because Nvidia reports late, much later. Here's the big, huge tech companies reporting earlier, and then Nvidia comes out. So this is going to be interesting. They typically report very well, and they typically beat their expectations, and they come up with rosy forecasts, and then they beat them again. So it's going to be interesting to see if they do it once again. Morgan Stanley here believes that they will. They're looking at the strongest results recently. They go on to say that they are expecting a good earnings report here. So this week is going to be interesting because usually when you have a big event like this taking place, and I think this will be, if they come out and they have really good earnings and forecasts for the future and really take away some of the concerns, that really could help move money back into the tech sector. If they don't come out as far as what their expectations go, that could put downward pressure on the tech sector because we did start to see those cracks last week, and we could see the tech sector start to pull back here. It's going to go either way on this. And so we're going to see the market probably be fairly flat Monday and Tuesday coming into the earnings. Anything can happen, of course. We saw that last week where companies were all over the place last week. So that was interesting. But I really believe this week is all about Nvidia on Wednesday after the bell. And that could bring a lot of excitement back into the market, or it could have a lot of tears on Thursday. So it's going to be very interesting this week to watch this. If you like this video, please click the like button and please consider subscribing as well to help the channel grow. Thank you very much.